Hello everyone and welcome back to another market review. This is Silent. Today we're looking at the NASDAQ December contract for 2025. Starting off with the weekly chart. I've added a Fibonacci to the previous weekly candle and I've taken measurements of the TGIF range going into 40 and 50% of the previous weekly range. Like we discussed yesterday, we were wanting to see if price could continue up on the week, but we failed to do that, and we're trading back inside the previous weekly's range. And so our drawn liquidity would be levels inside this range, and then as much as this buy side imbalance on the weekly chart. Today's candle drew down into 629, and that's 40% of the previous weekly's range. So I would like to see if Thursday's price action could produce a dip down as far as 565, and we have a couple of targets lower in here, but as long as we can see 565, that would be satisfactory to me. And on the daily chart, you can see where I'm getting the 560s level from, which is this daily buy side imbalance. I've taken your attention away from this wick on the daily that we were watching in the previous couple of days. After we traded down through that, we're starting to close below the constant encroachment of this wick. So my attention now is to see if today's daily candle could produce a drop to overlap the Wednesday candle's wick. So if we can drop below 687, start closing below there and treating it as a premium array, I'd like to draw down into the daily buy side imbalance. And as far as the constant encroachment of this wick, and I would like to fill up this range if there's no support whatsoever at the 560s level after we redeliver and attempt to rebalance this buy side imbalance here. Dropping down to the 4-hour chart, I've refined those levels again, and I've transposed our higher time frame levels down. So this is our daily wick, the daily buy side imbalance, and I've added a couple of levels, including that 4-hour buy side imbalance. I've added a sell side imbalance here. So I would like to see if price could trade up into the SIBI and roll lower going into tomorrow. I brought your attention to that balanced price range from the 4-hour chart, and we saw that delivery into the constant encroachment of that range and the stopping power from the constant encroachment level. They stopped the bodies right on top of that midpoint range perfectly, and then sunk it, doing a market structure shift here on the 4-hour. So this is starting to give us a notion of a more sustainable bearish run about to begin, which is where I'm getting the lower levels from as my draw on liquidity. On the hourly chart, we could see how price respected that balanced price range even with the bodies on the hourly. We sunk down below the new week opening gap. It retraded into midnight opening price and then traded lower and then rebalanced this range here and displacement to the downside, which is also producing that SIBI from the 4-hour chart. So because this is a balanced price range, I would not like to see price deliver higher than the high of the SIBI, because if it does, the bearish idea could be nullified. We have that 1-hour buy side imbalance that price drew down into, and that I brought your attention to yesterday, a nice bounce from that range. So we delivered from the shortable level down to our target perfectly, pretty much in one shot. So I'm interested to see if that kind of idea would happen again after redelivering to the high of the SIBI or the consequent encroachment of the SIBI and trading lower and finally wreaking havoc on these trailed buy stops down here. On the 15-minute chart, we can see how price consolidated through the Asia range and then drew up into that 4-hour balanced price range. Attempted to sell off from it, but it was just at the open of London. So we got a Judas swing on London. It rallies up, takes out early shorts, then consolidates all throughout the London lunch. And going into the pre-market, we get a shift of structure here. Bodies are starting to attempt to close below the low of the balanced price range. So if we begin to retrace and stay below constant encroachment of that range, we're going to stay bearish. Price consolidates going into the New York Open and does a final push up into this rejection block, staying below the constant encroachment of that range still, and then sinks lower, doing a shift under the London low and the Asia range low. We put in an up close candle while tagging one tick into this SIBI that was produced. Institutional order flow intradrill here on top of the new day opening gap and the midnight opening price. This up close candle becomes a bearish order block after we trade through it. We get a shift under that low and price produces another up close candle, which just simply trades back up into this wick of the institutional order flow entry candle. Notice how we're kind of connecting each significant turning point together. So we see that the low is produced in London that could be purged later. We get a rally from it. Price starts respecting the higher time frame level for bearishness. We get the shift, and then every level that responded to this one is respected as well. So this up close range gets respected as we continue to shift to the downside, and there's no need to retest the constant encroachment of this range because it put a bearish order block on top of it. Trade lower, another bearish order block, trade lower, consolidation, and then finally like stacking propulsion candles here, and then finally as the New York Open we Judas swing up with this wick, take out buy side, and then sink lower. And so the candle that reacted from this level sinks, and we're connecting it here with the institutional order flow intradrill. So this is the new hot PD array. Price trades below it and then respects it again. See, we're trading into those levels where smart money is selling. Okay, so they're keying up on this happening. So they're selling, taking profits a little bit, selling more. Price trades lower, shift, selling more, and then they take their profit as we sweep under those lows and into the hourly buy side balance. And then price begins to consolidate, and we start to respect down close candles as price retraces going into the end of the day. On the 5-minute chart, nothing really that I wanted to add in terms of drawings, but there's a couple of things I wanted to speak about. We can see that consolidation on the London lunch and in the pre-market. We get that closure above the 4-hour balanced price range, and then a significant shift lower with displacement. And the sell side imbalances produced here are respected. Notice how it's kind of consolidating on this retracement and moving very slowly as it comes up to retest these levels. It's kind of indicating to us that, yeah, this is a retracement, And then we get the confirmation with the single down close candle that overlaps all of that retracement. So it's confirming that market is in fact bearish and it's heavily accumulating shorts, because every time we produce a range of up close candles, we just close strongly below them in one single candle, if that makes sense. We come up right before the New York Open, start respecting this SIBI, overlap this buy side balance, retrace up, swipe all the liquidity from the pre-market, and then sink lower, leaving this imbalance, and then produce another one. So this is the main thing that we're looking for to take a short off of, and we're willing to see price trade up into this level only with wicks. We prefer this gap to stay open completely. After we get a closure here, we can begin shorting. Price is overlapping with the new day opening gap there, so we begin accumulating shorts, and then finally a shift below. I was watching this up close range. After we shift below that, that becomes our bearish order block here. And then we go up one more time for good measure, take some buy side liquidity, and then it is shifting lower again. Finally, one more retracement just before the lunch opens into this imbalance. This is your last opportunity to sell in a fair value gap that's offered. Price rolls lower, shift again. We're continuously getting shifts of structure to the downside. And then one more time, we sell in this doji style up close candle, and then it's off to the braces going into our hourly fair value gap target. On the 1 minute chart, the only thing I wanted to add was the first presentation fair value gap. So consolidation, rally up, take liquidity, shift, and then after it retraces into the first presented fair value gap, it's no longer willing to retest it. So this is your most prime opportunity to get into the trade before everybody else gets chopped up through this consolidation, waiting for it to trade lower finally. So this is definitely the thing you should be looking for. It can get you into trades early enough so that you don't have to weather the storm of all of this back and forth price action. Notice how clean it is compared to yesterday. There is wicks on either side of every candle body during this consolidation, but it doesn't seem to be as bad. The structure looks a lot nicer, and we can see our more important levels inside this consolidation compared to if the wicks were larger. It'd be harder to pinpoint things like the order block and the fair value gaps that were interesting. They'd be hard to recognize. So finally, going into 11 o'clock, we get a strong shift lower with two sell side imbalances. You could be a seller here, here, or here, as long as you're inside that range. You recognize that this gap can be traded too, but with just wicks. So the stop loss would have to be above a high here. We shift lower, create a new sell side imbalance, and then begin melting down, going into that target for the end of the day. Alrighty, so that's going to be it for me today. Hopefully you learned something. If you found anything insightful, leave a comment, and don't forget to like and subscribe. I'll see you tomorrow.